This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in trading ranges. Second leg traps are common when the market's in a trading range or in a broad channel. The market has a first leg, a pullback, and then a second leg, and the second leg can be extremely strong. It's an attempt to break into a trend. However, because of the 80% rule, traders know that 80% of these strong breakouts fail, and they trap traders into buying at the top or selling at the bottom, and that's the exact opposite of what the institutions are doing. It's better to fade breakouts, look for reversals, bet that the breakouts will fail. I'm going to talk about how to enter on reversals. Most traders should be entering with stops. When a reversal is strong, look for a second entry. Many experienced traders like to use wide stops and scale in. They trade small enough so that their risk is no bigger than on any other trade. Also, they have to be emotionally comfortable enough as a trader to do what they're planning to do. Beginners oftentimes, when they use a wide stop and they think they're planning to scale in, they exit with a loss when the market starts to go against them instead of adding to their position. Here's a 60-minute chart of the euro versus the dollar. Trading ranges are filled with two-legged and three-legged moves, wedges and two-legged moves. For example, there's a small wedge here, 1 or 1, 2, 3, and then a bigger wedge here, 1, 2, 3, wedge, 1, 2, 3, wedge, 1, 2, 3, but two legs, 1, pullback, 2. And clearly the first leg up is a wedge, and then we have a big breakout attempt, but it reverses, 1, pullback, 2, the first leg being a wedge. Second leg is a parabolic wedge, 1, pullback, 2, pullback, 3. 1 pullback, 2, 1 pullback, 2, subdivided, a wedge here, 1 pullback, 2, 1 pullback, 2. Trading ranges are just filled with two-legged moves. As I said, many subdivide into three legs. Wedges are common. 1, 2, 3, 1, 2, 3. When the market's in a trading range, traders should look to buy a reversal up near the bottom, especially if they see two legs down, 1 pullback, 2, or a wedge, 1, 2, 3. And the same over here, 1, 2, 3, or 1 pullback, 2, but it's also a wedge, a spike and channel, spike, pullback, and then channel. Also, they should be looking to sell reversals down from the top, especially if the top has two legs up or a wedge. Here we have a second entry short. First entry is below the bull bar after 4 or 5 bars up, not a high probability bet. Now we have a big bear inside bar and a micro double top. We went up and down and then up bigger and then down. This is a higher probability short. Here we have a wedge, 1 pullback, 2, pullback, 3, and a lower high. Look to sell the reversal down. Again, micro double top, micro triple top, up, down, up, down, up. Failed breakout above a major lower high here. Failed breakout on the top of the trading range here. Reasonable short. Now we have a wedge rally or two legs up, 1 pullback, 2. Traders look to sell the reversal down. Beginners are naturally hopeful. Everyone is naturally hopeful. Beginners, when they see a strong breakout, they're hoping that it's the start of a trend because trends are easier to trade. You simply buy and hold a wide stop and let it run. You can make a lot of money doing very little work. Beginners get excited when they're seeing strong breakouts like there or here, or a strong sell-off here or here or here. When the market's in a trading range, these breakouts typically fail and do not become measuring gaps. They become exhaustion gaps. They close. Beginners see the strong breakout and they're buying hoping for a measured move up. Instead, the breakout fails and the trading range continues. And that is because 80% of breakout attempts when the market's in a trading range fail. Beginner sees the market accelerating upward, and then they finally see this very big bull bar closing on its high, and the beginner buys, confident that it's either a bull leg in a bull trend or a bull leg in a trading range. And if it's a bull leg in a trading range, he can buy more, and it will come up high enough so that he can get out above his average price and make money. But that's not what he's going to do. He's going to buy that close and then panic when he sees this big bear bar or more bear bars or a big bear bar like this, and then he'll finally sell down here instead of looking to buy more down here. Another huge bull trend bar, and beginner looks at that and says, wow, this has to be the start of a trend. I'm going to buy as the market's going up. It certainly will go up if it gets above this high. So maybe he buys on a stop just above this high, gets filled right around here, hoping that it's going to be a trend. Even though these three tails took about 10 to 15 minutes to form, that's not much time if you're a beginner. You're hoping that it's going to go up for a measured move, maybe based upon the height of this bull trend bar. So the beginner buys up here, he puts a stop down here, and he exits here. This is a give up bar. This is bulls giving up. The beginner ends up taking a big loss. Now he sees a higher low major trend reversal. Bear trend here, strong breakout, higher low, and now it's accelerating upward. He buys again, but he fails to look to the left and see that the market is not above the trading range, and that every time the market has been at this price, it's sold off. And he's betting this time it's going to be different, and that's a mistake. Most trading range breakouts fail. And the opposite is true at the bottom. He sees a collapse here, trapped bulls, and now he sees a big bear bar near the low. It certainly has to be the start of a big bear trend, and he'll sell the close of that bar, betting that it's a sell the close bear trend that will go down a long way, maybe for a measured move based upon the height of that rally. The beginner bought high, he sold low. He bought high again. When you get these immediate reversals, they're shocking if you're a beginner because you just don't understand how that could possibly be. You think you're finally taking a trade that an expert trader will do, buying a strong breakout, looking for a measured move up, selling a strong breakout, looking for a measured move down. And you're shocked when you see it reverse immediately like that, or like this, or like this, or like this. You're paralyzed into a bad trade. You cannot exit. You're just hoping that the market will come back your way, or at least get back to your entry price to allow you to get out without a loss or maybe with a small loss. He thinks he took a good trade, buying the strong breakout or selling the strong breakout. And the result is he does not exit. He holds, hoping that the market will come back and allow him to exit without a loss, or hope that the market will become a trend and he'll make a lot of money. And hope is never part of trade management. People naturally are hopeful. However, when it comes to trading, you cannot be hopeful. You have to be objective. If you're buying at the top of a rally that has a lot of trading range price action, it's probably a bull leg in a trading range, which means it's going to be followed by a bear leg in the trading range. You do not want to be buying high, and you do not want to be selling low. That's the exact opposite of what the institutions are doing. Micro double top here, 1, 2, 3. Big bear bar closed on its low, parabolic wedge. To me, that's a sell signal. It's certainly a good reason to get out of longs. Different ways to draw a wedge here. 1, pullback 2, pullback 3. It's also a double bottom and a higher low with a good-looking bull bar. If any trader sold that bear bar, he has to get out above this bull bar. Failed breakout above the top of the range. Micro double top, this high, and then a pullback, and then a second high. You can call it a triple top. You have a big bear bar closing on its low. it looks like the bull trend might be reversing or at least pulling back deeply, you have to get out below that bear bar. Wedge, 1, 2, 3, parabolic wedge, and a double top lower high. Broke out a little bit above this sell climax, and then reversed down with a big bear bar. You have to get out by the close of that bear bar or below that bear bar if you bought up here. You should not be buying up here. You should not be buying up here. You should not be selling down here. But if you make those mistakes and you see an immediate reversal, you have to get out. Expert traders bet that breakouts will fail, and when they see a breakout, they're looking to fade it. They're looking to take a trade in the opposite direction. Two legs up, one pullback two, a wedge here, parabolic wedge here, consecutive complex tops. The bulls are expecting exhaustion and a reversal down. Parabolic wedge, a big reversal down, and a second entry. First is below a bull bar, and the second is below a bear bar after a parabolic wedge and complex tops. Wedge top here, pullback, and then a complex top here, parabolic wedge. Complex meaning 2 or 3 legs up. Bulls will sell out of longs below their signal bar, but most of the bulls taking that sell are the ones who bought down here or here. Beginners should not be buying up here and then selling. They should not be buying. But if they do buy, they have to sell. And bears will sell because they see the consecutive tops. They know the bulls are going to exit and look to buy lower. Therefore, the bears expect they can make a profit. The rally looks like a bull leg in a trading range, and therefore they're betting we're going to get a bear leg in a trading range. The bulls have a micro double bottom, this low, that low. After the big reversal from the parabolic wedge, they can sell with a stop below the bear bar, or they can bet the high one bull flag will fail and place a limit order to sell at its high. And you can see as soon as this bar went above that pullback bar, it immediately reversed down strongly. No one was buying above that bar. Consecutive bear bars probably will retrace down to the bottom of the buy climax, the parabolic wedge, maybe all the way down here. Bears will start to sell closes on the reversal down. Two legs down, one pullback two. At this point, the market is in a trading range. It's also possibly still in a broad bull channel that has not fallen below the bottom of this strong rally. In either case, traders expect a second leg down to fail and to reverse. When an experienced trader sees an exceptionally big bar late in a trend, 20 bars into the trend or so, especially if he looks to the left and he sees that the market is still making a higher low, he's going to buy the close of that big bear bar, betting against a successful breakout below the bull leg, betting that it'll reverse up and form a double bottom with this low or a double bottom with the bottom of the bull trend. There's also a parabolic wedge. Also, the channel up is fairly tight. When you have a fairly tight channel like this, one of two things is usually going to happen. You're going to get a pullback and a bull trend, or a very deep pullback and a trading range. At this point, we have big up, big down. A trading range is more likely than a bear trend, and a trading range has deep pullbacks, and it tends to reverse up near the bottom of the range. Here we have 3 consecutive bull bars closing above their midpoints. A reversal. It reversed this final bear breakout. Traders bet that the bear trend will not resume and that there'll be buyers below and will get at least a test back up to this buy climax high. And therefore, they'll place a limit order to buy at the low of that bull bar and then a stop below here, betting that even if we sell off deeply, and we did, the market will come back to the entry price, allow the bull to get out without a loss. It probably will go above, allowing him to get out with a profit. And some of these bulls will buy here and add on here They could get out part or all of their position at the original price, and now their entry price would be down here at their second entry instead of at their first entry. Very often, when the market's in a trading range, you'll get a strong bull bar, and you're thinking, it might be becoming always in long. I think it needs one more bar. Whenever you have that sense that I think it needs one more bar, traders will bet that the bulls will not get that one more bar. And the result is experienced traders will sell strong bull bars, betting that there'll be at least enough of a pullback so they can make a scalp. And that's true all the way across here. Huge bull bar. Probably needs one more bar to make traders believe it's a trend, and the bears will bet the bulls will not get that bar. And they were correct. The result is bears are looking to sell any strong bull close near a top of a possible trading range. 3 legs up, 1, 2, 3. A lot of trading range price action. We sold off here, we sold off here, we sold off here. We're back at that price level. We're testing the breakout point from this breakout. That's resistance as well. Possible trading range pullback here. Traders will sell the bull close. This is strong enough for a second leg up. Traders will sell the bull close, especially when there's a tail on the top of this bar and a tail on the top of this bar. Expect that the market will get up near here, maybe all the way up here, but not much higher, and then pull back. They know that the bulls who bought that high close and who held and scaled in lower above the bull bar are hoping to get out near break even on their first entry. And this is pretty close to it. And it's certainly above their average entry. They buy here, they buy more here. Their average entry price is here. So this is the sell zone for the scale in bulls. And the rally here, modest sized bars with prominent tails, looks like a bull leg in a trading range. They're looking to sell strong bull bars betting against a trend. Strong reversal up, small bar, maybe a 50% pullback, a test of the breakout here. Here's a breakout point. Here's a breakout. Here's another breakout point, broke below it. Bears are expecting the market to stall at resistance. Big breakout, huge bar, big tail on top, possible failed breakout. Bears will sell that strong close. Bull trend trying to resume, but a possible parabolic wedge. And it's testing this high close. The bulls who bought here, some bought more here. They're trying to get out break even here. Other bulls who bought here sat through this and now are very disappointed and have decided that a trading range is more likely than a bull trend. They're selling here as well. So you have bulls selling up here. The bears know that, and they will look for a strong bull bar to sell, betting that the bulls will not buy more. They'll, in fact, be happy to get out with a small loss, and the bulls will sell on that strength. So the bears sell on that strength. And the opposite is true at the bottom. When you look at a sell-off and it looks like the bears need one more bar to turn this into a bear trend, the bulls will use the 80% rule. They'll bet against the bears getting that one more bar. They'll look for strong bear bars, big bear bars near the low of anything, and they'll buy. Big bear bar near these lows, they'll buy. Big bear bar trying to get a breakout, the bulls will buy, betting the breakout will fail. Bears getting a breakout below a double bottom. Very strong rally here. More likely the first leg down will fail and there'll be one more test up. It's a 50% pullback. It's a test of the breakout above all of these highs. Instead of betting that this breakout is going to succeed, bulls will buy that strong bear bar, betting it will fail. Parabolic wedge down, 1 pullback, 2 pullback, 3, testing a breakout point. Strong bear bar, bulls will bet that it'll reverse up just like it reversed up on this tail and it reversed up on that tail. The bulls are going to buy any big bear bar on the close near the bottom of the range. Because the market's in a trading range and breakouts usually reverse, traders have to learn how to enter on reversals. In general, trading range, buy low and sell high and take quick profits. Traders should look to be buying in the bottom half, preferably in the bottom third, and they should be looking to sell in the top half, preferably in the top third. One of the difficult things buying low or selling high is when you're selling high, it's never really clear that you're selling the top. It often goes a little bit higher. And when you're buying low, it's never clear that you're buying the bottom. It often goes a little bit lower. Whenever a leg up is very strong, it's usually better to wait for a second signal. Here we have a very strong rally, and the first reversal down was below this bull bar. It was this tail. Rather than taking that, the odds are it's going to go up at least a little bit more. Traders should wait to sell a second signal, especially below a bear bar. Very tight bear channel, first signal, maybe a second signal. Here, there's a second signal below this low, small double bottom, and a bull bar, buy above the bull bar. Here, the bull's trying to bottom here. You could call this a second bottom attempt, trying to bottom here, bottomed here with a good bull bar. It's also a failed breakout below a double bottom. A failed breakout below a double bottom is a wedge. The market sold off, rallied, sold off, rallied, so we have a double bottom. It sold off below and rallied again. We have a pullback, first leg up, second leg up. It's also a wedge, a third leg up. Instead of buying above that doji bar, you might buy above this second doji bar, a second entry buy near the bottom of a range. Or if you prefer, you can wait until there's a big bull bar that was here and buy above its high or above a bull bar in a pullback from this reversal up. Opposite is true at the top. Micro double top, we went up and then down and up again, down. Here we have a wedge. So one attempt down, two attempts down, three attempts down, four attempts down. I still think of this as a second entry short. Here's the first, here's the second. Micro double top, up, down. Traders could sell either below the doji bar or better below the bear bar. Beginners should only be entering with stops, and they want to be buying in the buy zone, the lower half, and selling in the sell zone, the upper half. The market is probably going to go your way, so the probability is in your favor. You have high probability. For example, sell below a bear bar, reversing down from the top half of the trading range, and buying above a bull bar on a reversal up from the bottom half of the trading range, especially if you're taking a second entry. Second entries are good because it's two attempts to break out and both are failing. Higher probability that you're going to get a reversal. Sometimes you get a clear stop entry for a second entry. For example, stop entry here, stop entry here. Other times you get a micro double top, and it may not be all that obvious that it's a micro double top, but it's micro double top, or you get a micro double bottom, micro double top, up big and down big, a micro double top. Obviously a double top here, micro double top. It's actually a micro triple top. Two legs down, one pullback, two, slightly lower low double bottom, a second entry buy, decent bull bar. If you want, you could wait until there's a strong reversal up and then buy, for example, above that bear bar or above this bull inside bar. Even though you're buying fairly high above the range, you're buying a fairly strong reversal up, and some traders would buy closes on the reversal up. This is a little bit trickier. Most beginners should not be taking this trade. Chances are this breakout's strong enough to get at least a small second leg up. This might be the end of that second leg up, and we could reverse down. Just like here, this tail on the top of the second bar or the tail on the top of the third bar turned out to be the second leg up. There was another second leg up here. Whenever a leg up is strong, it's usually better to wait for a second sell signal, because chances are if you have a strong leg, there'll be at least a small second leg up. Again, micro double top here, micro double top or triple top here. If you're in the top half and you got a pair of bear bars, you're probably going to get at least a small second leg down, maybe to here. So the odds are you'll make a profit. Here, two big bear bars, probably going to get at least a small second leg down. Remember, the bulls, after a strong bear leg, are looking to buy a micro double bottom, and therefore, after the first bottom, there's probably going to be a second. Also, you're selling in the top half of the range. And that's true with these buys at the bottom as well. Strong enough rally, bears don't want to be selling in the bottom half. Bears don't want to be selling a first reversal down because they're confident there'll be a second leg up, and therefore bulls will buy betting on the second leg up. Strong reversal down. We're still in the upper half of this bull leg, potential trading range. Traders will sell the close of this follow-through bar, bear bar follow-through, probably at least a small second leg down, possibly a measured move down to the bottom of the range. This next section is not for beginners. When a trader uses a wide stop, he should not be a beginner. Beginners should stick with fairly tight stops, and anyone who's scaling in has to be an experienced, profitable trader. Let's say a trader bought for any reason down here, and then he gets this bull breakout, and then he gets this bull resumption up. If they're looking for a swing up, even if they think it's going to be a trading range, with all of these pullbacks, it's probably going to be a trading range. Once he gets this reversal up and then follow through, if he's holding for a swing up, he's going to put a stop below here. Here, a double bottom, slightly higher low, good looking bull bar, a wedge, second leg down, one pullback, two, and the market goes above this bar. It's reasonable to put a stop just below that low. The opposite is true at the high. If you have a good reversal and a good signal bar, you can use a fairly tight stop just above the high. In a few minutes, I'm going to be talking about expert traders using wide stops and scaling in. Beginners should not be taking that type of a trade. However, beginners can take trades like this and use a fairly tight stop when they have a good signal bar reversing up from the bottom of the range, or a micro double top and a very big reversal down, a good bear bar closing on its low. The same with right here. Rather than a beginner using wide stops and scaling in, they should rely on their tight stop. If they get stopped out, they'll look to buy again on a reversal up from the bottom. If they get stopped out at the top, they'll look to sell again on a reversal down from the top. If you get stopped out twice, stop taking that trade. If the market's rallying and you get stopped out twice, don't sell a third reversal because you're probably not reading the chart correctly. You're probably in a bull channel that could go up a long way and not in a trading range. And the same is true at the bottom. If you buy and you get stopped out, you buy again and you get stopped out, do not take the third entry because you're probably not reading the chart correctly. You're seeing a trading range and the market, in fact, is probably in a bear trend. Wedge bull flag. You could buy above the small bull bar. You can argue it's a second entry. Big sell-off, reversal up, trying to bottom again, second reversal up, or above this high. That would be another version of a second reversal up. If you bought above that small bull bar and you put your stop just below its low, you get stopped out here. You can buy again on a second reversal up above this small doji bar here or above this bull bar here. I want to say one thing about buying above that bull bar. Whenever you have a very small buy signal bar and you think it's reasonable to put your stop just below, the probability is you're going to get stopped out. And that's because whenever your risk is very, very small, your probability has to be small as well. You cannot have an incredibly great risk-reward ratio and a good probability. The probability is you're going to lose money. Whenever the risk-reward is very, very high, the probability is it's going to be a losing trade. And therefore, in general, if I'm buying above a tiny bull bar, I'm not going to put my stop just below the low of that bull bar. But if I did, I'm certainly going to buy again on a reversal up. And the opposite is true at the top. If ever you have a very tiny sell signal bar and you sell below the low of the sell signal bar, let's say you sell below maybe this bear bar, your risk is very tiny. If you put your stop just above, chances are it's a losing trade. However, if you win, you can win a lot of money that more than offsets the low probability of success. Sell below a small bear bar, arguing it's a bear flag, low 1, low 2. If your stop is just above, chances are you're going to lose money because the stop is very small. However, you can take a second entry short, maybe below this bear bar, and that would be a higher probability of success. If you use a tight stop selling below that bear bar, you get stopped out, which you would expect because your risk is small. The odds are the probability is going to be small as well. And that's okay. If you get stopped out, you can look to sell again on a reversal back down. Maybe below that bull bar or below this bear bar. Whenever you scale into a trade, you're increasing your position size, and that means that you're increasing your risk. Also, when you're scaling in, you're probably using a wide stop, and that already means that your risk is big. Traders who do scale in are trading small, and experienced traders who are scaling in manage their trades correctly. If they're planning to scale in, they actually scale in, and they don't get frightened and then exit as the market goes against them. They instead look to add to their position. Beginners, if they think they're going to scale in and the market starts to go against them, they exit and they never scale in, and they end up taking a lot of losing trades. Well, let's say we're in the top half of a trading range like this. We're still below the top of the range. We have a strong rally, probably going to get at least a small second leg up. This might be it. Maybe it'll be a little bit more. And let's say you sold at this high. Where should you put your stop? Well, you could use a wide stop based upon some kind of a measured move. We're getting a breakout, and the bulls are hoping for a measured move up. However, we have a lot of trading range price action, and the odds are breakouts will fail and not reach measured move targets. The breakout will be an exhaustion gap, and it will close rather than a measuring gap. And therefore, a reasonable location for a stop is just beyond the measured move up. You're not planning on letting the stop get hit. No one's going to let that stop get hit if they take this sell. However, it does give you time to manage your trade, to make decisions and to scale in. This breakout went 16 pips above the breakout point. Minimum scalp size is 10 pips. So you might sell 10 pips above this breakout point, thinking maybe it'll go up 16 pips above this high, just like this high went 16 pips above that high. A bear selling this high might look to scale in about 10 pips higher. He wants to be scaling in at least as big as a minimum scalp, because if the market comes back to his original entry price, he's making at least a minimum scalp on the second entry, and if he decides to get out, he'll get out break even on the first. And you can see a lot of traders did this. They sold here, they sold more 10 pips higher, and then look at this bar, down and up. And that tells you that a lot of the bears who sold this high did sell 10 pips higher and did buy back their shorts when the market got back here. And that's part of what caused that tail. If you're looking to scale in, most traders should not be scaling in 10 pips higher, 20 pips higher, 30 pips higher. Instead, they should rely on their stop and then wait for a bear bar and then sell more below the bear bar. only do that if your second entry is at least as big as a scalp above your first. The minimum scalp in the Forex market is 10 pips. Therefore, if you're selling below a bear bar and you're selling above your original entry, it's usually better to wait for a bear bar where the entry is at least 10 pips above the first. The bears who sold at this high got filled here. They sold more 10 pips higher. The market came back here. They get out break even on their first sell and a profit on their higher sell. Experienced bears will look to sell at or above a prior high when the market's in the top half of a range. Here's a prior high, so some bears will sell with a limit order at that high. Some bears will sell with a limit order at this high. Well, let's talk about these bears. They sell with a limit order at this high, and they get filled right here. If the probability favors a successful bull breakout, the bears are not going to sell. But when a rally looks like this and the leg up looks like this, it looks like a bull leg in a trading range rather than a breakout into a bull trend. If it is going to be a bull trend, the bulls will look for a measured move up based upon the height of the range, which would be this brown line here, and they therefore would put their stop just above. Again, they're not going to let that stop be hit. They'll know long before here that the market is turning into a bull trend, and they'll get out once they believe it's in a bull trend. But this gives them time to manage a short based on the correct belief that this looks more like a bull leg in what will become a trading range. The market rallied strongly. We have a bull breakout and a follow-through bar. Some bulls would get out on this close and then look to sell again on a reversal down. Some will rely on their stop and wait for a bear bar closing on its low and then sell more below that bear bar. Strong breakout bar, strong follow-through bar. Looks like it might be becoming a trend. Most traders should get out and take the loss and then look to re-enter if they get a reasonable reversal down. So exit on the close of the follow-through bar after the breakout, and now it's a 2-bar breakout. Looks like it probably will get a measured move up based upon the height of the breakout. The open of the first bar, close of the final bar, measured move up. You can sell then on a reversal down. You're selling, in this case, just about where you got out, and therefore you have a pretty good chance of recovering your loss, that the market will come back down at least to your entry price from your first sell. If you sold more, let's say you sold here, put your stop up here, did not exit here, and now you're getting a big bear bar, it's at least the size of a scalp above your first entry. A lot of traders will take their second entry below that bear bar. When the market comes back down here, they can exit the entire trade, break even on their first entry, and profit on their second, or they can take partial profits, get out of half of their trade here, which is basically getting out break even on their first, and then holding for some kind of a swing down on the second, or you just hold for the entire position because you now have a pretty good reversal and maybe the market will come all the way down to the bottom of the range. This second entry was 37 pips above the first. A trader who exited here would get out 37 pips profit on their second entry, break even on their first. The second entry, 37 pips above the first, is more than the size of a minimum scalp, and a lot of traders will only take a second entry if the second entry is at least as big as a minimum scalp beyond the first. Now, why would anybody scale in? There's one reason only for scaling in. It's to increase the probability of a profit, which means to reduce the probability of a loss. You can also do it to reduce the size of your loss. Whenever you're getting increased probability, you have to get worse risk reward. That almost always means bigger risk. And if you're having bigger risk, you have to trade small. If you take a trade and you think it's reasonable, and then the market does something that makes you think that your trade is not reasonable, some traders, instead of scaling in to make a profit, will scale in to reduce their loss or avoid the loss. This is a good choice for scale-in traders, selling below a bear bar, at least the size of a minimum scalp above the first entry. If a trader did sell here, and if he did not exit here, this is a very good place to sell more. He could get out at the midpoint between his two entries. He sold, his average price is right here. He could get out here with a small profit here, and then a small loss here, both the same size, and he avoids a loss. Here's his average entry price, the exact midpoint between his first sell and his second sell. He could get out here, and then his entire position is break even. He ended up making no money and losing no money on the trade. If he held and got out here, then he makes a scalp profit on his first entry and gets out break even on the second. He might hold all the way down here and get a profit on both his first and second entry trade. Is it reasonable to take this short? Sure. You're selling a breakout in a trading range, probable trading range. It's a reasonable thing to do. If a trader uses an appropriate stop and takes a reasonable trade, and he manages it well, in other words, relies on the stop and scales in appropriately, he has an 80% chance of avoiding a loss, at least getting out break even, and usually he'll make at least a small profit. However, those are big ifs. You have to make sure that you're reading the chart correctly, and this looks like a bull leg in a trading range. You have to take the correct entry. You have to use the correct stop. You have to be able to sit through a strong move against you. You have to be able to enter correctly, and you have to be able to exit correctly. That is too many things to do for a beginner, and therefore this kind of trading is only for experienced traders. When they do it, they have an 80% chance of getting out at least break even. Usually they get out with at least a small profit. Now, why even use a wide stop if you're confident that scaling in is going to result in at least a break-even trade and no loss and probably a profit? Well, it's because of black swans. I talk about this every now and then. A black swan is something unusual. In fact, if you were in England 500 years ago, you would believe that all swans are white. You would have seen hundreds of swans in your lifetime, and everyone was white. And you would therefore conclude that a black swan cannot exist. However, if you were a world traveler and you went to New Zealand, you'd discover that there are lots of black swans out there. And as a trader, if you're making assumptions based upon your experience as a trader, and your experience is not all that broad, you will be unaware of things that can happen that you think are not possible to happen. Those are black swan events. Black swan events are much more common than what you would think, and therefore you always have to have a stop in the market, just in case you're missing something and the market ends up doing something that you thought was not possible. Whenever you're using a wide stop, usually you're not going to let the stop get hit. You'll exit before the stop gets hit. However, let's say we get this bull breakout. Are you going to exit here? No, if you're looking to exit on a breakout, you exit here, not on the second leg up, because if the market is, in fact, in a trading range, it's probably going to reverse on the second leg up. So if you're looking to exit on a big breakout, a panic, and you're right near the stop, that's not what you do. You're going to be exiting early on the breakout, not late in the breakout right below your stop, because the odds are that it's not going to go above your stop and that this is not going to turn into a bull trend. A wide stop protects you against black swans, against a bull trend that just keeps going up and up and up. Even this breakout, tail, doji, another bull bar tail. That's not the way strong breakouts look. That has a trading range look to it. Therefore, using the wide stop bending against the measured move makes sense. Sometimes things that make sense fail. You always need a stop in the market because things that don't look like they're going to do something sometimes go ahead and do it. This does not look like it's going to be a successful breakout, but it could become a huge breakout, and therefore you need to stop. And your position size has to be small enough so that if your stop gets hit, your loss is no bigger than on any other trade. Now, can you just use a mental stop and get out at the market? Well, I would not do that because there are also black swan events in terms of the infrastructure of trading. Your internet can go down. Your computer can have problems. Exchanges and brokers can have problems. There can be software problems. There could be some phone call. You could pass out. You could fall asleep. There could be a family emergency. There are all kinds of unanticipated things that can happen. That stop protects you against all of those things. All of those things are possible black swan events. Second leg traps. Trading ranges are constantly trying to become trends. They're constantly breaking out of the top, trying to break out of the bottom, but 80% of breakouts fail. Those second legs that look like the market's breaking out into a trend are going to fail most of the time. When the market's in a trading range or a broad channel, you have to expect those strong second legs to reverse. And therefore, traders should look to fade breakouts. They should look to bet that the breakout will fail and enter on a reversal. When a leg is strong up or down, most traders should wait to enter on a stop on a second reversal. Experienced traders will enter with limit orders and scale in. They'll use wide stops, but that is only for experienced traders. I'm Al Brooks. This is the third of 4 videos on trading in trading ranges. Thank you for watching the Brooks Trading course.